So from Jay here, it says, good morning. My question pertains to being able to use accelerated banking / velocity banking to implement infinite banking. I have a balance on my HELOC that is large enough to prolong my IBC journey by 5 years, which makes me nervous waiting too long. So this is, I want to say, a slippery slope in my opinion. And this is something that I want to say I started talking about it maybe in 2020 and 2021 a little bit more, which is the idea, and I think I'd probably be much sooner than that. I haven't heard anyone in the infinite banking space, Nelson Nash Institute specifically, Become Your Own Banker, Bank on Yourself, Caleb, none of those guys, Garrett Gunderson, I've heard none of them ever talk about the idea of borrowing from a line of credit, a portion or all, to help an individual max fund a life insurance policy, borrow against that, throw it back in the HELOC, make an investment or do something to that effect. Or if it's just a matter of borrow from the HELOC to help max fund a policy, borrow from the policy to make an investment, buy real estate, do velocity banking on your HELOC in 12 months or less to bring it to zero, to do it again, to max fund your policy, to borrow, to make the investment. So now your borrowed dollars are earning interest. You then borrowed from that debt a second time. So money got used once to fund it, second to borrow, third to fund an investment, which is now earning interest and cash flow, let's say. And then you're doing velocity banking over here with all your income and cash flow, maybe the cash flow from that investment. And it's, radically paying down the line of credit to get your policy max funded again. That's a slippery slope. Not even going to be,
Right.
I'm not going to pretend
most
like
people should not. Yeah.
I bet like for the 44 people watching, it just went like that.
Right.
And
It's a
maybe
very
1%,
advanced strategy.
maybe 1% were like, I love it. I'm pretty sure J10's like, I love it. And those people I know I can like have some fun with. And I'm like, yeah. I get excited. I get all fired up because I'm like, isn't this cool? Right? I'm like, ball from here, and do them. So I get a little excited over it, but at the same time, I have witnessed, right? And this comes in hindsight, where I've witnessed successful case studies of people doing that. And I have 2 clients, I know their names, that were not successful by doing that. And for those 2 clients, not that the strategy caused them to be in a lapse pending situation on their life insurance policy. That's not it wasn't the strategy. It was their income changing in the process. One of those clients lost their income for a period of time. They went outside of my rules of leverage that I display on my channel. Every time I do a case study, I go over my rules of leverage and why I don't breach this and why I don't do that. And so it was a combination of their income interrupting or lower income situations, or expenses rising for the other client, expenses rising. And then now the strategy is starting to tighten and it becomes confusing now because it's not working the way they panned out. Life happened. And so we've got this issue. So for what Jay is asking is more than likely coming from content I've put out over the years. And I know it probably has some pros and cons of people trying to do it on their own. I'm someone that, and I could kind of like illustrate it on the board here so you can see where my finances are today. How I actually do this is I have my income that goes into a checking account, and that checking account is of a first lien HELOC. All right, so I have a first lien HELOC on my primary property, and then from that first lien HELOC, I'm funding 4 policies: 2 on myself, 1 on my fiance, 1 on my mom, and then I'm implementing a 5th on my younger sister and a 6th on my older sister, and just getting the whole family, building that whole banking system as is taught in the infinite banking world.
Right.
And then I take policy loans, right? It parks in the first lien for a temporary period of time, and then it goes to investments, right? Which the investments are me, like personal development, my YouTube channel, bringing on an assistant finally in my business. So I have a private assistant now, and building a team around me, and expanding my knowledge and influence and impact to create more cash flow, which that cash flow parks in the HELOC, which pays down, lowers the interest cost to borrow. Meanwhile, my interest is guaranteed, compounding, right, every single year. And then I'm creating this term that I know Caleb hates. It's positive arbitrage. Shout out to Caleb.
Right.
So that right there, I know it's crazy. For me, it seems so simple. And maybe a guy like Jay, maybe like yourself, it's like, I get it. I get what he's doing. And I've got leverage rules in all of this. I don't leverage more than 66% over here, more than 66% over here. I even have cash reserves over here, totally outside of the system. If all hell broke loose, I've got cash liquid over here, reserved, that I can inject into here to feed the strategy and quote unquote buy time to recover from whatever hell that broke loose in my life. So it's like, I've got stuff around here to protect this strategy, but ultimately it's the idea of being able to use money more than one time, over and over again. Now, could this be something, is this something you actually looked at before in the past, or you're familiar with, or you've done it yourself, or know clients that talk about it? Because that's basically what Jay is asking.
Right.
And I guess what would be some things that you would want him to maybe do in advance or be aware of for Jay?
Yeah. So, by the way, this is the kind of the first time me seeing anyone articulate what and how you're doing. So great. I mean, it's great. It's awesome. I like it. Right. Is it for everybody? Absolutely not. Right. I think for, unless you're like me and Denzel, we sit here and just go like, okay, how do we do, we love the intricacies. For most people, they should not be doing this at all. It's not that there's anything wrong with the strategy, but it is the overwhelm and the confusion that's going to kill the implementation process. That's the problem. So what we've been doing for our clients over the last 4 years, when this conversation is brought up, is we tell them, hey, it's a different, you can go crazy and super advanced, sure. What's more probable and what's more likely is that we want to help you make the first step, implementing it as simple as possible. We want to give you confidence. We want to give you the ability to go and say, hey, this thing is working. What's next? Because I think if you overwhelm people, it's game over, right? A lot of them will just kind of tap out and quit. So what we've been telling our clients is, hey, infinite banking is a whole different goal. Paying off your mortgage is one thing. Infinite banking could be a different thing.
Correct.
So what we have been informing is, hey, we can do a couple scenarios. None of these are right or wrong. It's just what is best fit for the scenario. So I've had clients who say, hey, I really want to do the IBC, but I also want to not pay much interest. Okay. For that scenario, what we've done is that individual has gone to a point, have used accelerator banking for maybe about a year or two, gotten to a point where now their mortgage payments have kind of flipped over to where it's more principal and less interest, right? It's kind of like 70% principal, 30% interest, right?
Okay.
They've flipped the ratio on the amortization payment. So they got to that point, like, you know what? I'm happy here. I'm going to now throw my extra cash flow to now funding my IBC policies. And for that person, it worked out because now their payments every month is a little bit more efficient towards paying down their principal. But now they're also funding the IBC. Another scenario is an individual who instead, from day one, instead of getting them a whole life policy, they went and got what's called a convertible term policy. And so they knew that, I can pay this off in, I can pay off my mortgage in about 5 years, right? And this is just a case study. And I know that I want to do IBC afterwards, but at the same time, I want to keep my premiums relatively low. They went and got a convertible term policy, which allows them to convert the term into a whole life policy later down the road, be able to bypass the underwriting process, and they're able to secure a lower premium for their whole life policy cost versus them getting it 5 years later. So they were able to do that. So they focused on one thing at a time, paid off their mortgage, freed up their cash flow, converted the term into a whole life. Boom, they're well on their way with their IBC. Granted, yes, they're going to miss out on 5 years of compounding interest, which could be a lot. I mean, you can make the argument saying, "Oh man, that's a lot of time that you lost." Sure. I've had another scenario where the individual is going to pay off their mortgage in 2 years. And this is a high income earning individual, lots of cash flow. So let me just paint that picture accurately. So what they did is, you know what? I'm going to actually, on purpose, pay this off in 5 years, sacrifice a little bit of my cash flow going towards the mortgage and the HELOC, and set it aside for IBC because I want to take advantage of the 5 years of compounding, or whatever the years compounding interest that I could have. So, yes. I mean, all different scenarios. It can be applied to different goals that you have. I like IBC. I love infinite banking. I do it myself. I have several policies myself as well. But it all depends on what you want at the end of the day. It really is. There's no right or wrong in any of these scenarios.
Mm-hmm. In hindsight, there's one factor that I now use to measure the individual, and I wrote it on the whiteboard here, is in order for this, I believe, to work well, not just work, but work well, is the person has to be a value creator with the intent of, I'm going to increase my income dramatically in this process. And so when I started this, like, I was making a certain dollar amount, and over the years, I've either been able to increase or maintain that income without increasing lifestyle too dramatically, right?
Yes.
Even with inflation and, taxes and all that stuff, life happening. That's where I use that one measurement along with others, but I'd say this is like the main thing for something like this. So to Jay listening, like, that's what I would do in that scenarios. Think about that. And I also do not believe that you should use 100% of your HELOC to fund the IBC policy. What I like to do, I've got my little funding mechanism. If I got a $50,000 HELOC and I've got $1,500 in cash flow per month, I'll do 66% of the 50. I'll take 1,500 times 12. And I say, look, here's your range. I would not go past 33. And basically letting them know, if you fund a policy at $18,000 a year, that's basically 100% of your cash flow is now going into this policy. What I like to see is, I would like you to have $18,000 day one to fund the first year's funding on that policy outside of the HELOC, right? That's what I like to see, where so you got first year's funding already in savings over here, and you're just going to reroute where you were saving money at the bank to the policy. And then 12 months from now, let's say we funded it at $18,000 a year with the ability to go up to 25. So then 12 months from now, you should probably have somewhere around 18 grand, and whatever we're short, that's where I pull from my HELOC to make up for that difference. And then I'm just doing Velocity Bank for a couple months, zero it out, and then no longer using Velocity Banking, and then figuring out what are we doing with the policy. All right. So I think that's way more efficient than where I have seen people literally do 100% borrow from their line of credit and tell themselves, I'm earning interest on the bank's money, and then I'm creating some kind of offset. And I'm like, no, you're not. Sorry to tell you this, you're actually paying interest in two locations now, your HELOC and the policy, and it takes a few years. It takes a few years for that policy interest to actually like look like something. So that's it there.